Next in my Are Options a Scam series, I'll look at the covered call in a crash market. I've been backtesting strategies for over 25 years. The goal is to find a system that is resilient, one that has minimal drawdowns and decent returns. The standard I use is the S&P 500. If the system can outperform the S&P on a risk-adjusted basis with black and white rules, then I consider that a good trading system. The most efficient way to backtest and eliminate a potential trading system is to take it through the toughest test periods first. If it can survive the tough test periods, then it's worth backtesting over a longer time period. The first thing I do when backtesting is take the system through all four market types to see if it survives. If the system can survive these markets, then it may be a viable trading system and worth further testing through years of time. My experience has taught me that when trading options, there is an edge when selling premium, and when buying premium, a low probability position is created. The low probability positions lose money over time. Therefore, as of now, my options trading scam series will not involve backtesting long options premium trading systems. Some courses and services are solely based on selling well-known trading structures and promise you that you can make money trading with them. This series on options trading scams is dedicated to backtesting the well-known options trading structures. Now first I will go over the type of structure I'm backtesting, and then I'll go over the management rules. So first I need to explain the three types of trading styles. Number one is always on, number two is opportunistic, and number three is a campaign style. And I'll be using an always on trade style in my backtest. And always on means that the position is always on, much like a long portfolio. With options, when a position closes, I will open a new position on the same day. The second type is an opportunistic style. And this is a variable trading system that puts trades on when there's an opportunity. A day trader falls into this style of trading, as they look for certain patterns, and when they emerge, the trade is opened. The third style is a campaign style, which means that a position is opened based on a calendar or time frame. A good example of this would be an investment in a retirement account where the money is added to the account on a monthly or quarterly basis, and the capital is applied to add to the current positions. Again, I will be using an always-on trade style in my backtests. In this video, I will backtest a covered call through a crash market, and I've already backtested the covered call in a bull market, sideways, and grind down market. See the links in the description for those videos. Now, here are the rules of the backtest. It's an always-on trade. I will use SPY as the underlying. I'll own 100 shares of SPY. I'll include commissions of $1 per contract and 0 cost per share of stock or ETF in commissions. I will allocate enough positions to use all available margin when applicable. I will run the test through all four market types, and this video is on the crash market. And the market types are bull market, which was January 1 through December 31st, 2017. Sideways market, which was January 1st through June 30th, 2015. Grind down market, which was October 1st through December 31st, 2018. And I will test the 2020 crash from February 1st to April 30th, 2020. Now, this is the market going down 35%. And then back up 35%. So that was from February 1st through April 30th. The 2008 crash took 2 years and 4 months to recover, so you have to keep that in mind, even though the 2020 crash recovered quickly. And the 2000 tech crash took over 7 years to recover. These are important facts to know when you're backtesting a crash market, because some recover quickly and some don't. I will sell the 40 delta calls that expire in approximately 30 days, and I will wait for the call to expire before selling another call or reestablishing a new position. Now, by the way, if you're interested in the software I use to perform my backtests, and monitor my positions, it's called Option Net Explorer, and I left a link in the description of my experience with Options Net Explorer and a link for a 10% discount off the product. So I'm going to go ahead here and start the back test. Okay, so now I'm going to go ahead and run these back tests. So I'm going to take the covered call through a crash market. We'll start Monday, February 3rd, 2020. We'll go to the end of April 2020. First thing I'm going to do is buy 100 shares. Let's go ahead and make that trade. Just call it trade number 1. Now let's sell a covered call. I'm going to go to about 30 days. Right here, we'll go to the 40 delta. 38.40 is probably closest, -1. There's our covered call. Okay, now we want to go till this expires, which will be in approximately 30 days. Let's go to March 2nd. It says 2 days left. Let's go to 0 and buy it back. Buy it back for 0. So we didn't get called out of our shares. We still own the shares. We're going to sell another call. 30 days out. At the 40 delta. Right here. Okay. Let's go 30 days out from here. It's going to take us on April 3rd. So we're right here, we're going to buy this back. We still own those shares. Now we're going to sell another call, 30 days out. We'll go to May 1st because that'll give us kind of right at the end, right at the end of April. So 40 delta. So we'll go to May 1st. And we're going to buy this back. You can see it's worth $25 or whatever. We're going to buy it back at 0. We're just going to keep the premium. And we're going to sell the stock at $2.59. Okay, and there we go. That took us to the end of the test period. Now we'll go ahead and I'm going to create the other trade, which is just a buy and hold. So let's go back February 3rd. 100. We'll go to May. It was May 1st. We're going to sell it. Now I'm going to run a couple of reports. We'll run it for 2020. Then we can see how we did. We lost $5,025 with the covered call. And how much margin did we use? I'm going to go back and take a look at that. $16,200. And 88. So we'll say it was $16,300 in margin. Because if we go back to the covered call, it should be probably just a little bit less than that. And you combine these two together. Yeah. So 16,300. Let's take a look at the report for the buy and hold. Buy and hold lost $4,128. Let's get our calculator. 5,025 divided by 16,300 minus 30, basically 30.8% on the covered call. $4,128 divided by 16,300, 25%, 25.3% loss on the buy and hold. So really you can come to the conclusion that when you have a crash market and you have a little bit of a recovery, the covered call strategy hinders, it slows you down, it's not as good. Because when you get called away, you don't get to capture all that upside. So that's kind of one of the deficits of the covered call strategy, is that you don't really want to use it in a crash market. If you're interested, I do have a free proprietary options trading course available, and I left a link in the description below to sign up for that course. And hey, don't forget to hit that like button on the way out. Thanks.